Banks are essential to a healthy economy. They act as intermediaries, connecting savers with borrowers. Without banks, businesses would struggle to invest and grow, and individuals would find it harder to manage their finances. Banks provide a secure place for our money and make it possible to borrow for major purchases. Imagine a world without banks. Starting a business would be extremely difficult. Buying a home would be a distant dream for most. Banks oil the wheels of the economy, facilitating transactions and enabling growth. Their importance is undeniable. From small businesses seeking loans to multinational corporations managing complex transactions, banks are woven into the fabric of our financial system. They are the engines that drive economic activity. Understanding how banks work is crucial for anyone who wants to navigate the financial world. Whether you're opening your first checking account or investing in the stock market, a basic understanding of banking is essential. One of the primary functions of a bank is to accept deposits. When you deposit money into a bank account, you are entrusting it to the bank for safekeeping. Banks provide a secure place to store your money, protecting it from theft or loss. In addition to security, banks offer convenience. You can easily access your funds through ATMs, debit cards, and online banking. No longer do we need to keep large sums of cash at home. Banks offer a safe and convenient way to manage our money. But banks do more than just safeguard your savings. They also play a crucial role in facilitating payments and transactions. Through checks, debit cards, and online transfers, banks enable us to move money electronically, making commerce more efficient. This ease of transaction is fundamental to the modern economy. Imagine having to pay for groceries or rent with bags of coins. Banks simplify our financial lives, allowing us to focus on what matters most. Another crucial function of banks is to provide loans. Individuals and businesses borrow money from banks for a variety of reasons, such as buying a home, starting a business, or investing in new equipment. Banks act as financial intermediaries, connecting those who have surplus funds with those who need to borrow. This process of lending is essential for economic growth, as it allows businesses to expand and individuals to make major purchases. Of course, banks don't lend money out of charity. They charge interest on loans, which is how they make a profit. The interest rate charge depends on factors like the borrower's creditworthiness and the prevailing market conditions. The ability to borrow money is what makes dreams a reality for many. Whether it's starting a business, buying a home, or pursuing higher education, loans from banks provide the financial fuel for countless aspirations. Banks are the invisible infrastructure that underpins our modern payment systems. Every time you swipe your debit card, deposit a check, or make an online transfer, you are relying on the banking system to process your transaction. Banks act as clearinghouses, facilitating the movement of money between accounts. They ensure that payments are made promptly and accurately, providing a seamless experience for consumers and businesses alike. This complex system of payments is essential for the smooth functioning of the economy. It allows businesses to receive payments quickly, consumers to make purchases with ease, and governments to collect taxes efficiently. The next time you pay for something electronically, take a moment to appreciate the intricate network of banks and financial institutions that made that transaction possible. It's a testament to the power of technology and the interconnected nature of our world. Section 5. The Money Multiplier: How Banks Create Money. One of the most fascinating aspects of banking is the ability of banks to create money. This process, known as fractional reserve banking, is how banks increase the money supply through lending. When you deposit money in a bank, the bank is required to hold a fraction of that deposit as reserves, known as the reserve requirement. The remaining portion can be lent out to borrowers. When that loan is made, new money is created. This newly created money is then deposited into another bank, which in turn can lend out a portion of it, creating even more money. This cycle of lending and depositing continues, multiplying the initial deposit and increasing the money supply. The money multiplier effect is a powerful force in the economy, but it also highlights the importance of responsible lending practices. If banks lend out too much money, it can lead to inflation and financial instability. Section 6. Navigating risks, a banker's tightrope walk. Banking is not without its risks. Banks face a variety of challenges, from managing credit risk to mitigating operational risks. One of the primary risks banks face is the risk that borrowers will default on their loans. To mitigate this risk, banks carefully assess the creditworthiness of borrowers before approving loans. They consider factors such as credit history, income, and debt-to-income ratio. However, even with careful underwriting, some loans inevitably go bad. In addition to credit risk, banks also face market risk, the risk that changes in interest rates or other market conditions will adversely affect their profitability. Banks manage market risk through diversification and hedging strategies. Operational risk, the risk of loss from internal failures or external events, is another challenge for banks. Cybersecurity threats, natural disasters, and human error are all examples of operational risks. Section 7. When the bubble bursts, understanding financial crises. Financial crises occur when the financial system experiences a sudden loss of liquidity or confidence. This can happen for a variety of reasons, such as a bursting asset bubble, a banking panic, or a sovereign debt crisis. During a financial crisis, banks may become reluctant to lend, fearing that borrowers will default on their loans. This can lead to a credit crunch, where businesses and consumers struggle to access the credit they need. Financial crises can have severe consequences for the economy. They can lead to recessions, job losses, and a decline in living standards. The global financial crisis of 2008, triggered by a collapse in the US housing market, is a recent example of the devastating impact financial crises can have. Understanding the causes and consequences of financial crises is crucial for policymakers and regulators who strive to maintain financial stability. By learning from past mistakes and implementing sound regulations, we can reduce the likelihood and severity of future crises. Section 8. Guardians of stability, the role of regulation. Given the crucial role banks play in the economy, it's no surprise that they are heavily regulated. Governments around the world have established regulatory bodies to oversee the banking sector and ensure its stability. These regulatory bodies set rules and guidelines for banks, including capital requirements, lending limits, and consumer protection measures. They also supervise banks to ensure compliance with these regulations. The goal of banking regulation is to promote financial stability, protect consumers, and prevent systemic risks. By providing a framework for safe and sound banking practices, regulators aim to create a stable and resilient financial system. Effective regulation is essential for maintaining public trust in the banking system. When banks are perceived as being safe and well regulated, it fosters confidence in the economy as a whole. Is Section 9, the evolving landscape of banking. The banking industry is constantly evolving. Technological advancements, changing consumer preferences, and new regulations are reshaping the financial landscape. One of the most significant trends in banking is the rise of fintech, or financial technology. Fintech companies are using technology to disrupt traditional banking models, offering innovative products and services. From mobile payments to peer-to-peer lending, fintech is transforming the way we bank and manage our finances. Another trend is the growing importance of sustainable finance. Banks are increasingly incorporating environmental, social, and governance factors into their lending and investment decisions. This reflects a growing awareness of the need for a more sustainable and inclusive financial system. As the banking industry continues to evolve, it will be fascinating to see how these trends shape the future of finance. One thing is certain: banks will continue to play a vital role in our lives, connecting savers with borrowers and facilitating economic growth.